The 10% revenue haircut. Google is about to trade a 10% revenue loss for its highest operating margins in a decade. While the press treats the Department of Justice's proposed final judgment as an existential threat, the P&L tells a different story. In the first quarter of 2026, Google network revenue shrank 4% while search and cloud accelerated. The assets the government wants to carve out are exactly the ones dragging down the consolidated margin. Alphabet isn't fighting to save its future. It is fighting a performative battle to keep its lowest-performing business unit from being sold at a fire sale price. This is a structural optimization masked as a legal defeat, and the market knows it. The real value is shifting from the open web toward owned and operated pipes. The network anchor. For years, the Google network business has been the unloved stepchild of the advertising segment. In April 2026, this division represented less than 9% of total ad revenue, yet it generates the vast majority of Google's regulatory heat. Unlike search, where Google keeps the lion's share of every dollar, the network business is a high-volume, low-margin intermediary play. It requires massive traffic acquisition costs and constant maintenance of a complex ad tech stack that publishers increasingly resent. By spinning off the ad server and the exchange, Google removes a low-growth anchor from its balance sheet. This isn't a breakup of the core business. It is a forced extraction of a low-margin commodity service that has outlived its strategic utility for the parent company. The compliance tax. The operational expense of maintaining a monopoly is becoming higher than the monopoly rent itself. Google's legal and compliance OpEx has ballooned as they fight 3 front-war antitrust cases across search, ad tech, and the App Store. In 2025 alone, the company spent billions on a technical committee and data-sharing mandates that slowed down their AI deployment. A forced divestiture of the ad tech stack effectively ends the interoperability tax. It allows Google to focus its technical talent on AI-native search formats that don't need to play nice with third-party publishers. The DOJ is essentially doing the cost-cutting that Sundar Pichai couldn't execute internally due to the optics of shrinking a legacy empire. The slim down is the strategy. The attribution feedback loop. The standard bear case is that losing the ad exchange breaks the data flywheel for search bidding. Skeptics argue that without seeing what happens on third-party sites, Google cannot prove the value of a search click. This ignores the reality of 2026. With the collapse of third-party cookies and the rise of privacy-preserving APIs, the advantage of owning the open web exchange has largely evaporated. Google's real moat is now first-party data from 3 billion users across Android, YouTube, and Maps. They don't need to see what you do on a niche news site when they already own the starting point and the video finish line. The attribution loop remains intact because the walled garden is finally tall enough to stand alone, the strategic slim down. The DOJ's final judgment is the catalyst for a fundamental pivot where Google stops trying to be the internet's utility and starts acting like its premium landlord. By jettisoning the network segment as highlighted in the margin analysis, Google preserves the high-yield O&O assets like search and YouTube while offloading the regulatory liabilities. For investors, the signal is a leaner Alphabet with a simplified cost structure and zero obligations to the open web publishers it has spent 20 years commoditizing. The real metric to watch through the end of 2026 is the search operating margin as it decouples from the network's drag. If that number clears 50% while the divestiture progresses, the breakup will be remembered as the most successful restructuring in tech history. Watch the Q3 earnings call for the first signs of this reporting segment realignment. Subscribe for more